So futures. One. So as I go back to read the question, you see some of these futures. One is that futures are standardized. In other words, they have a fixed maturity date. So unlike FRA, where you can just agree a particular time, futures have fixed maturity date. And that's why when you look at our question, which we are going to solve next quickly, you would notice right in the question it mentions. Right here it mentions under our futures that these futures mature at the end of the month. So you can see that we have September, December, and March futures because they have fixed maturity periods. That's one thing about futures. The second thing about futures, which you would note as we solve our question, is, which is very important, I just want you just to bear this concept at the back of your mind as we attempt the question, is that futures are sold in blocks. In blocks. Very important. And so let's look at this question again and see what we mean by that. We're going to solve the question. Just concept you need to bear in mind as we go back to solve the question. You can see right here it says that the futures are 500,000 contract size. In other words, if you want to buy these futures, you can only buy in blocks of 500,000. So you can buy 500K, you can buy 1 million, you can buy 1.5, because they are sold in blocks of 500K. So if you needed to borrow, say, 800,000, you can't buy a futures for exactly 800,000. You would need to buy for either 500, and then maybe the other balance of 300,000 you protect it with FRA or something else, or you buy 1 million. That's just a concept to know, really. Just a concept to know. We're going to look at it with an exam question. Very important to note that that second concept as well. 3, concept to note is that futures are settled in net. I'm going to explain this with that question. And that is what makes them derivative or investment instrument. And finally, important features of futures is the concept of basis / outstanding or remaining basis. So that is an important concept to pay attention to as we solve that question. Okay, so whenever you have a question on futures, now I want you guys to note that there are many approaches to solving question on futures. And so if you take a look at an icon pack on a futures question, you're going to see more than one method. However, all of the methods will generally lead you to the same answer. You don't need to know all of the methods, just stick to one. So I'm going to walk you guys through a simple method because it's methodical and it allows you to get all of the available marks. These are the things you do whenever you have a futures question. 1, steps. And then we're going to follow these steps one at a time, as it is when we solve our question. 1, whenever you have a futures, you need to determine the futures to buy. Because when you go to the futures market, like every other market, you're going to find different products there. So you have to decide which one should we buy. That's very important. And so that's why in our question as well, you're going to see September, there's December, there's March future. So we need to decide on which one to buy. Two, because it is not just a way to protect ourselves against interest rate movement, it's also an investment instrument. We need to develop a strategy. So we need to determine our hedging strategy. And there are two strategies only in the market. Whenever you're playing the hedging market, that is a long position or a short position. So you're going to take one of those positions. So when we solve our question, we're going to explain those concepts as we solve our question. 3, because futures are standardized, they are sold in block. We need to know how many are we buying. So we need to determine the number of contracts. Just a moment, I need to add admin someone. Okay, yeah, I think I have about 30% in. All right, yeah, we're good. Okay, so we need to determine the number of contracts. Because futures are sold in blocks. 4, concept as well as step we should have in our solution would be to determine the basis and remaining basis, if any. I'm going to explain why that is important as we look at the steps. And then 5 is, which is about the final step, except the question asks you to calculate what the interest is to calculate the lock-in interest rate. Which is the fixed rate based on this hedging strategy. All right, so these are the steps. So if you follow these steps, whenever you're dealing with futures, you would not get it wrong. And you will not overthink it because you have a methodical approach to follow. 1, what futures do we buy? 2, what's our hedging strategy? 3, the number of contracts. 4, basis and remaining basis. 5, we calculate our lock-in rate. And that determines what our locked-in LIBOR is. If we have any fixed element, which is 90 basis points, we'll just be adding the 90 basis points for every calculation we do, because that is not a risk. That is a certain value. Okay, so let's go to our question and begin with the first step. Determine the futures to buy. That's our step 1. So let's begin our calculation right away. Okay, so what are the questions? Okay, first step is the futures to buy. That's our first step. Okay, now let's go back to and see what futures we have in the market and which one should we buy? Which one are we meant to buy when we go to the derivative futures market? So we go into the market and say we want to protect ourselves. Mr. Big wants to protect himself against adverse movement in interest rate. And they say in this market we have September, December, and March futures. So which one do we buy? Now the futures that you would buy would be the futures that is open as at the date you want to borrow or invest. That's the futures we buy. We will buy the futures that is open . as of the date or as of the date we intend to borrow or invest, depending on what we are interested in or what we're looking at. So this is Mr. Big Heart. He wants to borrow. So first we need to determine what date does he intend to borrow this money. So once we know the date he intends to borrow the money, we can then go to the futures market and see which of the futures will be open on is open on that date. Okay, so let's go and look at when does Mr. Big Heart wants to borrow. Let's remind ourselves, maybe for those that just joined the class, the class. Let's look at when Mr. Big Heart wants to borrow. The detail is in here. Okay, so the detail is right here. Okay, so it says, I'm reading this line. Mr. Big Heart's group of companies have been able to raise a significant portion of the total amount needed for the purchase consideration of the club, but there is a shortfall of 150 million today, September 16, 2020. That's what they need to borrow. But when do they need it? And the total payment for the acquisition must be made by December 16th. So Mr. Big Heart needs to have the loan by December 16th. So if they go to the futures market, they should buy a future that is still open on December 16th. So let's go to our futures market and see which futures they have and which one is open on December 16th. Oh, sorry, I'm surprised that. All right, so these are the futures. It says derivative contracts may be assumed to mature at the end of the month. So our December futures is maturing at the end of the month. So it will mature September 30th. And then our December futures will start from, because there are 3 months. All of them are 3 months. So our next one will start from, the next one will mature December 31st. The next one will mature March 31st. And because there are 3 months, this one will be January to March, because there are 3 months futures. Because there are 3 months, this would be October to December, and this would be July to September. Mr. Bigger needs to buy one. He needs to borrow December 16th. We need a future that is still open by December 16th. We cannot buy the first one because the first one is maturing by September 30th. That's the far off from when Mr. Bigger needs to borrow. We cannot buy the last one because by December 16th, that last one will not have been opened. That last one is January to March. So it will not have been opened by December 16th. However, we can buy the December futures because it is from October to December 31st. And we need to borrow by December 16th. So the futures that Mr. Picker would buy would therefore be our December futures. So free marks, that's the free mark for us. So the applicable futures is the December futures at a price of the price December is 93.790. I'm going to explain what that means. In 93.790. Okay, the price of 93.790. So we get our full marks for that, for determining the date. The second thing we need to determine is our hedging strategy. Now pay attention to this closely. Now there are two hedging strategies. One is a long position. And second is a short position. I'm using this to explain. You don't need this in your answer, please. So the same thing at this one, you don't need this in your answer. Just put the futures to buy December futures at the price of 93.79. So second is a short position. Those are the two strategies in the market. So which one are we going to take? Now take note about two things about this strategy. When we say a long position, we're basically saying a market strategy where you buy now and then sell when price increase. So for example, basically every trader out there, commodity trader applies a long position. So they want to buy a product when it's low, they sell when the price is up, buy again, sell at a higher price, buy again, sell at a higher price. That is a long position. So when you want the price to keep increasing. So that's you buy, you sell at a higher price. So you want the price to keep increasing. Quick question. Between a borrower and an investor, let me hear someone's voice. Who do you think wants interest rate to keep increasing? Between a borrower and an investor? Can someone maybe just make use of the hand raise feature? Let me hear your thought about it. Between a borrower between a borrower and an investor, who do you think would want interest rate to keep increasing? So if you're an investor, yes, right, please go ahead.
Good morning, sir.
Good morning.
Investor they want to that will require a higher interest rate so that his money will keep increasing.
Thank you very much. The investor is the one that will require a higher. That's very true because as an investor, I want the interest rate to be going up. Maybe I invest today and I get treasury bill at currently it's like 14%. And maybe I invest again in 6 months' time, I see it at 20%. I want the interest rate to keep going up. That is what an investor wants. And that therefore means that the long position would always be the hedging strategy that will be undertaken by an investor. So whenever you have an investment in the question, you're trying to hedge interest rate, your strategy would be a high interest rate. So you take a long position. Now, who wants interest rate to be going down? A borrower, obviously. You want a situation whereby maybe you borrowed, you got a mortgage or you borrowed for a car or something at 10%, and maybe it's reducing to like 5%, so you want it to be going down. So that would be a position where you sell now and buy back. So you want the price to keep going down. So, and that would be a borrower. And that would be a borrower. Then let me digress a little bit to the investment world just for a maximum of a minute, and I'll come back to a question. Now, oftentimes when people buy shares or they have investment in shares, so for most people, they only have one strategy. What is that strategy? Let me buy the shares when it's 5 naira, I sell it when it's 10 naira. I buy it again maybe when it's 12 naira, I sell it when it's 20 naira. So you're looking at the position where you buy, you sell, you buy, you sell. That is a long position. Now, for people that only play in a long position, when the market begins to go down, they panic and they sell and they move out. They don't do anything again. However, in reality is that you can make money even when the market is going down. Let me illustrate quickly with something that we can easily relate, just in case some are not investors here, with something we can easily relate. Let's assume I have a TV and I bought that TV for 100K. And price of TVs keep coming down. And I say, well, because price of TVs are coming down, I sell my TV. Let's even assume I was able to lock enough to sell it at 100K. And then after a while, because price of TVs were coming back down, I bought that TV again. That same TV, I bought it again at 70K. The truth is that by that strategy, I have made some cash of 30K because I didn't lose anything. I gave out my TV for 100K. I bought it back again for 70K. The difference is 30K. So I made some small change on it. So that's generally the strategy that investors play when the market is going down and down and down. And borrowers want interest rate to keep going down. So they take a short position. So back to our question, Mr. Bighard is a borrower. So clearly, because he's a borrower, he wants interest rate to go down. So what strategy will he take? Mr. Bighard will adopt what? A short position. Is a borrower. And borrowers prefer a lower interest rate. And as such, the applicable hedging strategy is a short position. Okay, so you must not miss any mark on these first two steps. The first step, the date. The second step, the strategy. Even if you attempt to say, oh, I don't even want to worry my head on the reason why. Just note two things in summary. Whenever you are an investor, you're taking a long position. Whenever you are a borrower, you're taking a short position. And inflation is easy. A borrower wants interest rate to keep going up. Someone that buys and sells at a higher rate. So they take a long. An investor rather. A borrower wants the interest rate to keep coming down, keep coming down, keep coming down. So they take a short position. That's the second thing. Free marks on those two steps. Free marks on those two steps. Free marks on those two steps. Tolu, you want to quickly ask a question or something? Go ahead.
Good morning, sir.
Yeah, good morning.
Under the hedging strategy, from what you just explained to us now, is an investment decision. But I'm looking at it from the angle, what if I'm a short-term investor?
No, we're not looking at investment. I'm only using interest investment to explain. We're looking at interest rate risk management. So interest rate could be because you're an investor, you're trying to protect yourself against interest rate risks. Or because you're a borrower, you're trying to protect yourself against interest rate risk. So if you're an investor, you're looking at a situation where interest rate will keep going up. So you adopt a long position to protect yourself against adverse movement in interest rate, regardless of whether you're a short-term or a long-term investor. But if you are a borrower, what do you prefer? Do you want interest rate to keep going up or falling? If you're a borrower, what do you prefer?
Falling.
Thank you. So because interest rate is falling, you take a short position. So you can sell and buy back. Yeah.
That's the angle I'm looking at. I may decide because I'm a borrower. I have a lot of commitments. I don't need to go for a long time. I need to take my decision. I need other place to put my money. So I can't take that long.
No. The term long and short doesn't refer to the duration. It's just a term used to explain the strategy. It doesn't refer to the duration. It's just a term that is used to explain the strategy. So when I say long position, I'm not talking about how long you need to invest. I'm only basically saying you're adopting a strategy where you would prefer interest rate to go up. Is that clear? So whether that is for 1 month, whether it's for 2 weeks, whether it's for 3 years, whether it's for 10 years, you would prefer a situation where you want interest rate to go up. It doesn't speak to how long you are investing. Okay?
Thank you, sir.
All right. Okay, so free marks on those two steps. The next step, number of contract. And that is very important because, like we mentioned, what do you call it? Futures are sold in blocks. So we need to determine the number of contracts, the number of contracts. And this is pretty straightforward. That's the formula for it. It is the amount. So is it the amount you want to invest or the amount you want to borrow divided by the contract size multiplied by the tenor of your loan or investment. Tenor of your loan or investment divided by the futures duration. So this is pretty straightforward and the free mark as well. We're going to pick the values from the question. Mr. Bighard needs to borrow the sum of 150 million. If it was an investment, we'll just pick that up. So here, Mr. Bighard needs to borrow the sum of 150 million naira. So let's look at that quickly. He needs to borrow the sum of 150 million naira. That is what is needed. And it goes to the futures market, and the futures guy says, we sell our futures in 500,000 contract size. So let's put that part of the formula first. 150 million divided by 500,000. Okay, that would be 150 million divided by 500,000 multiplied by the tenure of the loan or investment. When Mr. Bighard borrows, for how long? Back to our question. I know we've read it before, but back to our question. Question says Mr. Bighard wants to borrow by a La Liga club, and when they borrow 150 million, it's for 2 months. So it's a 2 month loan. The 2 months loan that they need. That's what they need as the tenure of the loan. It's an investment to be how long do they plan to invest the money. So the tenure of the loan is for 2 months. So that value is in months divided by futures duration. Our futures, what is the duration or the tenure of our futures? Let's go to our question and look at what the futures market tells us about it. Future market tells us that our futures are 3 months sterling futures. So our futures have a duration of 3 months each. So that 3 months sterling futures. So that would be that divided by 3. Okay, so divided by 3. So that gives us, by my calculator, 200 contracts. Free marks as well. Formula is pretty straightforward. Just plug in the figures and you are good to go. All right. Next concept. So we've looked at step 1. We've looked at step 2. We looked at step 3. Now let's look at step 4. Step 4, okay? After an hour of the class, we take 10 minutes, 5 minutes break really, and then we can then continue. So let's look at step 4, and then we'll take a few minutes break, and then we'll come look at step 5 and options. Okay, so step 4 is basis and remaining basis. Now, let's go back to what we said Mr. Bighard bought. Mr. Bighard, today, based on our explanation, where's that graph where I drew that line? I think it's up here. Yeah, I think it's, yeah. Okay, so Mr. Bighard, today is 1609. Mr. Bighard is buying a futures, December futures. And the question tells us that futures matures at the end of the month. So in other words, it will mature by What day in December? December 31st. These are our futures that Mr. Bigheart is going to buy, and which matures at the end of December has a price of 93.79. It has a price of 93.79. So if Mr. Bigheart were to borrow on December 31st on the dot, we don't have a problem with basis and remaining basis, because the price on the 31st of December, I think I should draw another line so I don't mix it up with the FRA. So let me put it down, 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 down. Let me draw another line down. Okay, let me draw it here. All right, so we have today is 1609. Mr. Bigheart needs to borrow December 16. This is the day we need to borrow. But because futures have a fixed maturity date, he bought a futures that is maturing on December 31st. So Mr. Bigheart is not going to hold these futures until maturity, because it matures on December 31st. This is the maturity date. This is the maturity date. He needs it on this date because this is the day he needs to borrow. If he holds it up to December 31st, the price he has agreed is 93.79. That is the price. It's 93.79 if he holds it up to maturity. But it's not going to hold it up to maturity because he needs to borrow before December 31st. So we need to find a way to adjust the price to December 16 price. That is where the concept of basis and remaining basis will be applied. So we need to find a way. We need to find a way, or in other words, we need to adjust the price to December 16th price when the borrowing is required. When the borrowing is required. If he held it up to 31st December, we don't have a problem because that is the price of maturity. But he needs to borrow before it matures. And that is where the concept of basis and basis, remaining basis, comes into place. So let's now begin with the concept of basis. What the concept of basis basically says, we need to know what the price is, the difference in price is between today and December 31st. Let's begin with the basis. So we need to know what is the difference in price between today, which is LIBOR today, and December 31st, which is the futures price. Good. Now, first, let's look at what is the price today. What is LIBOR today? Let's go to our question and see what the interest rate is today. Let's see what the interest rate is today from the question. Okay. Right here, it says currently, which is noun. Currently, LIBOR is at 6%. So currently or today, interest rate is 6%. So we have a situation where the interest rate currently is at 6%. Let me write that somewhere. Okay, sorry, to write down. Okay. So we have a situation where interest rate is at 6%, and we have bought a futures that fixed interest rate to 93.79. Now, this 93.79 that is used in the market is referred to as market reference rate. So to get the percentage equivalent of 93.79, we basically say 100 minus the reference rate of 93.79. So that gives us the value in percentage. So that would be 100 minus 93.79, and that gives us a value of 6.21%. So currently interest rate is 6%. Mr. Big Hat has bought a futures that fixes interest rate at 6.21 on December 31st. But we are not waiting to December 31st. We're borrowing on December 16th. So we want to adjust the price to December 16th price. So let's look at the difference between now and December 31st price. So now the price is 6. December 31st, the price is 6.21%. So we converted that to the market reference rate to percentage. So that is a difference of 0.21%. Now, pay attention to this. From today to December 31st, how many months do we have? So we have, today is September 16th. So October 16th will be 1 month. November 16th will be 2 months. December 16th will be 3 months. December 31st, that's from 16 to 31st, is approximately half month. So from today to when the futures will mature is 3.5 months. That's the total duration of what we have. The total duration from today to when it matures is 3.5. And then from today as well to when we need to borrow is how many months? So we have September 16, October, November, December. 3 months. 3.0 would be the period that the futures would be in our hand, and then would sell it. So we'll have 0.5 or half months unused. So out of the 3.5 months, which is from today to December 31st, we are only going to hold on to the futures until when we need to borrow, which is December 16th. So we have like 5 months to when it actually meant to mature unused or outstanding. So we need to calculate what that amounts to, the value that amounts to. So how do we calculate what that amounts to, which is what is called outstanding basis. So that will be calculated by unused period divided by total tenor or total tenor multiplied by this, which is called our basis. So what is our unused month? We used out of the 3.5 month, we're going to hold it for 3 months up to December 16, which when we need to borrow. So we have unused of 0.5. Total from the beginning to the end is 3.5 multiplied by minus 0.21. This is minus. So what does it give us? Minus, what's the minus? So that's 0.5 divided by 3.5 multiplied by 0.21. So that's minus 0.03. All right, so that is our basis and remaining basis. So we need to adjust our
question.
price by this amount. Just a moment, I'm going to check your question. We need to adjust our price by this amount because this is the price for the period that we're not going to hold on to the futures. It is called remaining basis or outstanding basis. Okay, let's see if we have a question and then we can take it. You need to understand the step very well. Yes, Tolu, go ahead.
Okay, my question, sir. That 6.21%, how do we derive that 6.21%?
Okay, good question. Let's take it one more time quickly, and then we'll take 5 minutes break. We're done with that. Then we'll come around up in the next 15 minutes. Okay. So we said that our December futures, the price is 93.79. That value is called market reference rate. It is not in percentage, but we need to know what it equates in percentage, because if I tell you interest rate, you want to know what the percentage is, what the value is in percentage. To find the percentage is clearly here, 100 minus whatever the market reference rate is. Can you see that?
Okay, 100 basis points, Abi.
Yeah, 100 minus 93.79 gives you what the value is in percentage, and that is what gives us 6.21%. So that's clear.
Okay. Thank you, sir.
All right. Any other question on basis and remaining basis? So what we're basically trying to do in summary is we're saying I bought something that is maturing December 31st, and the price, if I hold it to December 31st, is 6.21 or 93.79 in reference point. But I'm not going to hold it until December 31st because I want to borrow December 16th. So can we adjust our price to reflect December 16th? Yes, we can. Let's find the difference. We find out of the total period, what period is it going to be outstanding that we're not going to use or we're not going to hold on to the instrument, and we find the remaining value. Okay, so let's take 3 minutes break, and I will continue in the next 3 minutes, which is in 45, which is at 5:45, and I will do for 15 minutes. All right. So if you need to grab water, you need to stretch for like 3-4 minutes, or you need to have a quick look at what we've discussed up to this point, please do, so that the remaining 5 minutes or thereabout will take your questions. So see you guys in 3 minutes. Thank you. Okay, I hope we've had a chance to stretch a little and maybe grab water or something close to our desk. We can push for the remaining few minutes. Okay, all right. So, quick recap of what we've done up to this point. Mr. Baker is concerned that interest rates might move in an unfavorable direction. And he said, to manage this risk, let me go to the futures derivative market and buy the futures. That would allow me to fix my interest rate so that regardless of what happens, I have my interest rate fixed. That is one option. You could have used FRA as well, which we discussed earlier. It's an option for it, but we're looking at all the different options. And it goes to the FRA market and buys December futures. And the December futures has a price. We've explained why he picked December up to this point. It has a price of 93.79. That's the price in our question. But to calculate the percentage value, it's 100 minus 93.79, which is 6.21%. That is the percentage value. If Mr. Bicard were to borrow on December 31st on the dot, we don't need to do any adjustment because that is the maturity date. However, he's borrowing on December 16. So we need to adjust for the period he's not going to hold on to that futures. And that's what led us to calculate basis and remaining basis. And we determined that the value we need to adjust would be minus 0.03. So we need to adjust our price of 6.21 by 0.03. And that is what is called the lock-in rate. That adjusted price that locks in what our borrowing would be. So how do we calculate that rate? We said it's 6.21. We need to adjust it by 0.03, which is the difference, which is off from that difference between when he wants to borrow and when the instrument is meant to mature. So that is our final step, which is our lock-in rate. And it is our futures price plus the outstanding or remaining basis, depending on what term you prefer calling it. So outstanding basis, which is the adjustment we are making due to the difference between when it's maturing and when we need to make use of that, when we need to borrow. So if we had held on to it, we would have borrowed at 6.21%. But right now, we need to adjust by 0.03. So plus minus becomes minus. So that is 6.21 minus 0.03. It gives us 6.18% as liable. So regardless of what the interest rate is on December 16th, regardless of what the interest rate is, if it's like, let the liable interest rate be 100%, 200%, as immediately Mr. Bicard enters into this contract, they have fixed their borrowing at 6.18%, and the market would ensure that they get 6.18%. But don't forget, we mentioned when we started that Mr. Bicard will always be able to borrow at what? LIBOR plus what? What is that? LIBOR plus 90 basis points. Mr. Bicard would always be able to borrow at LIBOR plus 90 basis points. Risk is the likelihood that something might go wrong, which is the LIBOR. It can change. And that is what we're trying to manage. The 90 basis point is fixed. So whenever you do your calculation, you would always add the fixed element because it is not risk. It is certain. It is known. So we're not managing what is already known. What we're managing is something that might go wrong, which is the risk. So our 90 basis point will always be added whenever we finish our calculation. So that would be just add our fixed element, which is 90 basis point. Which is 90 basis point, which is 0.9. And that gives us our total cost, interest cost, of 6.18 plus 0.9. 6.18 plus 0.9. And that gives us 7.08. Okay. So one key note about futures, which is something to note, is the agreed price or the agreed rate is the interest rate at which Mr. Bigard will borrow, regardless of what the actual interest rate is on December 16, at which Mr. Bigard will borrow. Regardless of the actual rate. Regardless of the actual rate on December 16, which is when he needs the money. Now, there is a problem with this. And I want to believe you can see the problem with me as well. Mr. Bigard must borrow at that rate because that is what the agreement it has entered into. But what happens if on December 16th, LIBOR, unfortunately, Mr. Bigard was initially afraid. Mr. Bigard was initially afraid that interest rate might increase. So they went into FRA to fix their rate. But unfortunately for them, in December 16th, interest rate fell, or LIBOR fell to 3%. That's the problem for Mr. Bigard. Why? Because they must borrow at a LIBOR of 6.18, which is what they have fixed. And that becomes a problem for strategic financial managers. So just imagine that you told your company that, oh, interest rate now is 6%, which is what we have today. Yeah, which is what we have today, 6%. And you tell your company that, I think I'm concerned that interest rate might get to 10% on December 16th. So please, let's do futures. And your company hurriedly goes to enter into futures. And after they adjusted the price, they arrive at the price of 6.18. And then December 16 comes. Instead of the interest rate going to 10%, the interest rate goes to 3%. Some people might not have jobs anymore because you put your company in a position where instead of saving them money, that transaction is costing them money because the actual interest rate on that date is lower. And that is the problem with futures. So for many strategic managers, they want to have the choice or what is called option to decide whether or not they want to go ahead with the contract on that date. If you enter into a futures, you don't have that choice. You must borrow at 6.18. So if interest rate is even 1%, you must borrow at 6.18 LIBOR, and which might not be flexible. So some strategic financial managers want to say, okay, can I have an instrument or a situation where I can make a choice? If it favors me, I will go ahead with the contract. If it doesn't favor me, I will pull out. In other words, if I had gone with option and the interest rate drops to say 1%, I can decide to say I have the right based on the contract. So I will not go ahead because I bought an option. I won't go ahead with this contract anymore because it doesn't favor me. If you buy a futures, you must go ahead. And that is what leads us to that last option in the question, which is called option.